had $2 million contracts, not LOIs, not not LOIs, full-blown annual contracts that were renewable annually, each for over $1 million or near $1 million. I think one was 900 something, the other one was over. So basically, from two contracts, they had 2 million in ARR. They came here as foreign students, so to go to college. So their English was kind of weak, actually, like very heavy accents. On Zoom the first time, it was actually like so. And that only matters not for me. It matters for me. My perception of their ability to go out there and sell this and do this. Like, okay, it's three engineers that have no connections here, don't know, have no way to get into enterprise or the business. This, but they need to sell this to big enterprise. Punchline is, by the time I met with them, turned out, I'll tell you who the two contracts were. One was one of the three big oil companies. The other one was the U.S. Navy. Now, three engineers with limited English, they're just no excuses. That's my definition of scrappy, get shit done. I don't know how. I cannot do what they do, no way in hell. But how do they, have the ability and no excuses about I can't do this, I can't do that, I don't know how to get a hold of the right people. In doubt for the Navy deal, a Silicon Valley based startup that just raised a Series B. So the Silicon Valley based startup has raised a $30 million Series B at a 200 million valuation. Uh, this startup that was raising basically a seed round, I won't disclose the numbers, but it was, a small fraction of that. That's amazing. That's the horse I want to bet on. That's exactly the definition of what I'm looking for. I'm looking for teams that do a lot with a little and have no excuses and just get shit done. You don't know what you can't do, you just do it.
Today's guest is a super angel. He's invested in over 500 tech companies. He's also the managing partner at Emerging Ventures, a venture capital fund focused on new technology companies. And he's also been involved in multiple traditional businesses, what you would call insurance, car lending, etc. So he's got a fascinating story. He's bridged the two worlds of venture capital, tech, and the traditional industries. And so today we're going to get to hear about his stories, investments he's made, and ultimately his story. Without further ado, David, welcome to the Builders and Funders Show.
I'm glad to be here, Burke.
It's a pleasure having you. I want to start with going all the way to the beginning of your career. You started out in insurance, I believe, in 1989, and then got into auto lending in 1999. I want to ask you, what do you think about? You've now seen the tech world. You've seen those traditional businesses. If you're a young person today, how would you go about thinking about the two of those worlds and which one to get into?
Well, if you don't mind, maybe I can walk you through a kind of short version of how I got to where I am, and then we can go back to your questions. I think that might be relevant. And um, by background, in the late 80s, I was studying math and computer science. Undergraduate was dual major of applied math and computer science. And then by the time I was in graduate school, it was by then 1990 to 91, things started to fall apart for basically that industry. PhDs in math were being laid off from industry. The defense industry was crashing. Out of the doctorate program, did not get my doctorate, and instead went into business because it seemed like just you know nothing there in academia. It's like fast forward, spent more than 25 years building mostly underwriting businesses, mostly businesses that were balance sheet companies, that were underwriters, that were risk-bearing entities in both finance and insurance. How I bridged to where I am today and why I changed, it goes back to around 2011, 2012. At the time, I had two operating businesses. I had the auto insurance underwriter, Alliance United, and I had an auto finance company. And in both of those worlds, around the same time, I started to have vendors come to me with some really innovative products, or what at the time seemed innovative, and opened my eye to where technology was. Because to be honest, I was all in on my world. I was going to insurance conferences, claims conferences, all kinds of legal and HR conferences, and finance association stuff. And I saw what was being presented to those industries, but I was not aware of what was going on in Silicon Valley in the startup world. And I didn't know about accelerators. I didn't know about venture capital. I knew I had these new vendors come to me, which were actually, you know, startups, venture-backed startups that were doing some pretty cool stuff. And at the time, it was probably mostly natural language processing kind of things. Like, say, a vendor would come in for the insurance company and say, "Hey, we can take these mountains of unstructured claim notes that you have and give you insight on them." And I would be like, wow, that would be awesome, but I don't believe it. That sounds too good to be true. And they would do a proof of concept and it would really work. And it's like, wow, that's amazing. And that opened my eyes. Like, okay, what I wanted to do 25 years ago is now real. It's actually here. I started to see a lot of these things like I want to be involved in that. So that got me excited to dig in and learn about where technology is, where AI is. I started reading about AI, about technology. Startups started joined angel groups, started going to technology conferences, like the tech crunches of the world and all those kind of things, and various things in Silicon Valley, primarily initially in the Bay Area. I would fly back and forth. I'm in LA, so I would go for a day or two each time to different things in the Bay Area. Started talking to other fund managers, the GPs of funds that were involving in technology, see what they're investing in and why and how they see the world. And I got super excited about that. And it was to a point where, like a couple years into doing that and angel investing on the side in some of these, and where I said, my businesses were pretty big by then. And I love the product side, but when they get big, it's all about compliance and HR and, um, regulations and all that, and a lot less about the product. And my day job wasn't as fun. It's like I really enjoyed every time I would be out talking to tech startups about what they're building. That would be more fun than running my business. So I was like, okay, I want out. I want to focus on technology. And I wasn't sure what form it was going to take, but I knew I wanted to be involved in that, and I wanted out of my day job. And even though we were doing well, and I hired investment bankers for both sides, did a process, and exited both the operating businesses we had at the time, and became by a full-time angel investor and just started doing this in essence full-time. Kind of didn't know exactly what I wanted to focus on yet. It was all exciting. Probably made a lot of mistakes, did a lot of things I probably wouldn't do today. Because when you first start angel investing, just everything seems so cool. Everyone's so smart, everything's so exciting. Uh, you know, a thousand startups later or whether you see 1,000 of the same thing and you realize that maybe they're not so great anymore. It's like, okay, no, I've seen 900 that do it better. This is not so awesome, but initially everything seems awesome. And so I wrote a lot of small checks and built a portfolio. And that's really how I made that transition. It's just I deliberately made the transition. Is the short answer. Is I saw where technology was, got really excited, and said that's where I want to focus. The next say 20, 30 years of my life. I don't want to spend that time in an office managing an operating business. That's just one business. There's too much going on in tech right now. It's too exciting. It's so amazing. I don't want to be left out of it. I want to be somehow in on that, talking to the geniuses that are inventing the future, being by their side.
Yeah, absolutely. So you mentioned you're doing these businesses, auto lending, insurance, anything in underwriting. You exit both of those businesses because you don't want to do that anymore. What were those first angel checks that you wrote? What were those companies?
Boy, the first ones were probably indirect. They were probably through various syndicated deals through other GPs where so it was deals that came to me and I didn't look for them or things. And also, my first direct checks were probably startups that I saw pitching at various tech events that I was attending. So I didn't have deal flow at the time. So my connections were eventually to other GPs, and then eventually through the various events. I just went on my way and say, let me find events that talk about tech, and you find all these tech conferences. Um, in California and eventually around the country, and university programs and pitch events. And you start going to events. You sign up and you spend an afternoon here and an afternoon there, and uh, going to all these different pitch events and conferences that include often startup pitch events. And you just start to meet a lot of founders, and you eventually write some checks. And I can't tell you what my first direct checks were. It's been so long ago, and there's been so many since. I don't.
Now, I want to take you down memory lane. Like, we'll get a little nostalgic here.
Mhm,
So, you mentioned, you're getting a few deals referred to you, but to really ramp up, you start going to these events, right? I'm sure, like,
mhm,
these events are filled with other angel investors. To the extent that you can recall, what made you see a entrepreneur pitching and go, you know what? This company is the one I want to invest in.
mhm.
This company, not so much. What were some like
Right.
examples maybe of those as well of companies that
Yeah.
you saw, like students, etc., where you're like, these people I'm going to write a
Yeah.
check to?
Right. So, initially, like I kind of alluded to before, initially I was too eager and everything seemed cool. Everything seemed amazing. So I probably wrote checks to a lot of startups that I would pass on today because I've seen a lot more. I got a little more sophisticated in my underwriting process for startups and a lot more cynical probably too over time. You see everything that goes wrong. So initially, I wrote a lot of small checks to a lot of startups that I've seen at events where I just got excited about what they were doing and maybe didn't even realize that there's probably 10 other startups doing something similar and doing it better. Uh, where, because I didn't have that sample set yet. My world was only the ones I saw. And from the ones I saw, it's like, okay, I'll go to an event. There might be a dozen companies pitching, and one or two would really pique my interest. Where like what they're working on is really interesting. I really like that. And then I would, you know, participate in whatever due diligence was going on. And if it turned out okay, then eventually I would write a check, and many others I wouldn't. Um, I say over time, that process has got a lot more refined. Now I will see at least 30 deals a day, and I write maybe one check to two checks per quarter. So I write, 5 to 7 checks maybe a year, this whole year now of direct new deals that I'm doing. And I've probably seen 5,000 deals in a year. So I can rule out now like 99% of my inbound deal flow, I can rule out almost instantly as because I narrowed my thesis. And like I've said, over time, you see a lot of similar kind of things and a lot of categories of things. And you see something that's like, okay, that's in that bucket. And what they're doing just isn't so exciting. I've seen things that were more exciting. The threshold now is to find something that's get something that's really exciting today. The threshold's a lot higher because I've seen so much, and it's got to be something that I'm so excited about that I say if this is the only deal I ever did my whole life, if this is now a deal like I'm basically going all in on this business, I was going to devote my whole life and life savings, my time and my money to growing this, helping this business. Would I be willing to do that? And if the answer is no, then I don't invest. The bar is that high. It has to be something that at that moment I'm so excited about. And so they have to be doing something really, really interesting and be doing it better than anyone else that I've seen. So, and what gets me specifically, what gets me excited is people that do a lot with a little. So they move fast and they're capital efficient. If they can get a lot done with very little time and money. So they're just, they're scrappy, they're resourceful, and they just get shit done. They know how to, because they're the guys who, no matter what happens, will figure out a way. They'll probably pivot 3 times until they find the right product market fit, but they'll get there. They won't give up, or they won't get stuck to one way of doing it. Because they're the kind of guys that will just figure it out and find a way and make it happen. So what gets me excited about a team and the founders is guys who get stuff done and looking at a business. It has to be something interesting, but they have to be doing it also in a way that is fast moving, capital efficient, and just seems like the way a scrappy startup should be. I have zero patience for those who said like, oh yeah, we spent the last 5 years gathering our IP and building a team, and now we're raising all this money so we can go to market. It's like, no, thank you. That's the corporate way. That's not the startup way. And that's kind of extreme, but you see that sometimes too. And that's of no interest to me.
Mhm. Now, David, you mentioned at this point you're getting so much deal flow that you're looking at over 30 deals almost a day,
Mhm.
over 5,000 deals a year. And so I'm sure there are a few deals over even the last week, I'm sure, that have
Mhm.
stood out to you, or the last month or last 6 months that have really stood out to you where you thought, whoa, these guys are like, it gets my heart pumping. You start like, you jump out of your seat and you start
Yeah.
walking around. That's how excited you. Tell me about some of those deals and the stories behind them.
So, okay. I'll give you an example. Here's an example of one that there's a startup. I guess I'll leave the name out. I'll give you the concept, although if someone wants to dig through, they'll probably figure out who it is. So this is going back probably 4.5 years. It was, I think, right before COVID, or maybe the beginning of COVID. But there was a startup based out of Texas, and um, still to today, actually, I never met the founder in person. I met him on Zoom initially, so it must have been right at the beginning of COVID. Not, and um, they're doing drone delivery to hard to reach places, autonomous drone delivery. Um, and these are big drones. These are not little toys. These are like, something with a wingspan of probably like 6 to 8 feet. Um, and they're delivering, and their version one was 20-pound payloads. Their version two was 50-pound payloads. Um, what got me excited? I'll tell you what got me excited. First time I was going to roll them out. Well, first of all, they're a referral. The founder was referred to me by another portfolio company founder. And I was catching up with him and about, just our regular catch up about what's going on in his startup that we already invested in. And he said, "Hey, by the way, I want to introduce you to my friend who I just met, and this other guy who we brainstorm with. He's doing something similar but not competitive to what I'm doing because it was also a drone company. And it's what he's doing is really amazing. He's really smart. I think you should meet him. He's racing around right now." And it's like, sure. So it was already a great intro from someone I trust. But, founders that you like, their friends will probably be founders that you like. So that's a great intro. So it's already a great warm intro. When I met him, I found out what they're doing. The concept was like, yeah, I don't know. That's complex. That's hardware. It doesn't sound, at the time, there's a lot of drone stuff going on. It didn't sound that unique. Here's what got me excited. By the time he was talking to me, they've been around. I forgot how long by then, maybe 2 years, maybe 3 years, maybe somewhere in that range, say 2 to 3 years that they've been. It was like three guys that met in college. They were really, really smart. But they were all engineers. Um, they came here as foreign students, so to go to college. So their English was kind of weak, actually. Like, very heavy accents. They can write well, but it was hard to communicate with them. Meeting them on Zoom the first time, it was actually like, so in my, and that only matters not for me, it matters for me, my perception of their ability to go out there and sell this and do this. Like, okay, it's three engineers that have no connections here, don't know, have no way to get into enterprise or the business, this, but they need to sell this to big enterprise. Uh, and um, I would have ruled them out as like the least likely to succeed. It's like, okay, they're smart engineers, but how are they going to build a business that's scalable and do this? And they're just engineers. There's no business guy there. And but here's what got my attention. The punchline is, by the time I met with them, they had $2 million contracts, not LOIs, not not LOIs, and not pilots or beta, but full blown annual contracts that were renewable annually, each for over $1 million or near $1 million. I think one was 900 something, the other one was over. So basically, from two contracts, they had 2 million in ARR, and they've only spent to date before I met them to get to that point, like less than $2 million to get there, to build the prototypes, start the company, develop all the tech from scratch, and build something. And it turned out, I'll tell you who the two contracts were. One was one of the three big oil companies. The other one was the US Navy. Now, three engineers with limited English, they're just no excuses. That's my definition of scrappy, get shit done. I don't know how. I cannot do what they do, no way in hell. But how do they, have the ability and no excuses about I can't do this, I can't do that, I don't know how to get a hold of the right people in big oil and sell them on using them and then repeat the process with the Navy. And they beat out for the Navy deal a Silicon Valley based startup that just raised a Series B. So the Silicon Valley based startup has raised a $30 million Series B at a 200 million valuation. Uh, this startup that was raising basically a seed round, I won't disclose the numbers, but it was, a small fraction of that. And they were raising this seed round. They previously raised the pre-seed, and they were now raising a seed round, and that's what I was participating in. And that traction, that's like, oh my God, that's amazing. That's the horse I want to bet on. That's exactly the definition of what I'm looking for. I'm looking for teams that do a lot with a little and have no excuses and just get shit done. And it amazes me that they were able to do that still to today. I mean, 5 years later, I go back and think about that conversation I had with them. And when they first told me what they did, it's like, I don't believe you. That's ridiculous. It's like, no, you have an LOI. It's like, no, I have a contract. It's like, show me. And they gave me the data room, and they have, a contract with one of the three big oil companies. If I gave you the name, you would know who they were. And they had a contract with the US Navy. And still to today, they're the only civilian company that's allowed to land. At least this is their claim. They're the only civilian company that's allowed to land on an operational uh, Navy aircraft carrier. And,
Wow.
so yeah, and they did so much at that time with just so little resources of money and time and personnel and everything to get to that first stage and get those contracts. They just didn't understand. They didn't have the even try to think about why they can't do that yet. So if you don't know what you can't do, you just do it. And that's like the example of where someone else would plan this and spend years. And I mean, and they went out like right at the beginning before they almost had anything. They had this barely working prototype, and they went out and bid on, the two biggest customers in the world, basically, you know, the U.S. military and one of the big oil companies. And it's like, wow, okay, that's the kind of guys I want to back. And they might fail, they might make it. They've since raised two more rounds. They've done pretty well. It's not growing as fast as we would like because that's a tough industry. But
Wait,
uh,
David, did,
it's still
did,
doing
did
pretty
you
well.
did you say they just found a bid that was by the oil company and then by the U.S.
No,
military to
they they
submit their
they
demo?
they bid. Well, the Navy contract is one of those things where it's an open like RFP process, right? Request for proposal, and you have to go through and you have to demonstrate your tech, and the Navy has to they have to vet your tech and approve you, and you have to do all these demos. The Navy would specify like, hey, they want you competing with others to prove who can do this better, and then they have to select somebody for it, right? Uh, they were competing with particularly this one other startup that was much better funded, by an order of 10 magnitude at least, better funded than they were. And they beat them out for that Navy contract. And that's a fact. That's, there. So that's really what got my attention. I mean, just the oil contract probably would have been enough. If the fact that they had one of the big, the Navy thing was like, wow, that's just freaking amazing. I can't believe you guys did that. And, that got me super, super excited to immediately drop everything and dig in on the due diligence. I wanted to see those contracts right away and validate that. And it turned out all to be true. And I wrote them a check. And, and so we're on their cap table since probably early 2020 or whenever that was. So 4 years now. And, still happy to be an investor in them. But what happens later doesn't matter. The point is that's what you're asking, what gets me excited. That's what gets me excited. It can be, and that's a relatively extreme version to show you what can be done. So when you hear other young people giving you excuse after excuse after excuse, oh, I don't have rich parents, I'm not connected, I don't. I have a strong accent. I can't do this. I can't do that. Oh, I need to get some more experience first. I need to get an MBA. I don't. I, bullshit. You want to get stuff. You want to get it done. You can get it done. I've seen it over and over and over. Those that want to get it done find a way. They get it done, and it's a mindset. So when it comes down to it, it's those with that kind of can-do mindset are the people I want to work with.
Interesting. Interesting. By the way, how did they? So I get the Navy part. How did they get a big oil contract? Do they just like find a
Well,
bunch of
Big
people
Oil
that
was
could?
looking for no, Big Oil was looking for that, I guess, and or they reached out to them. I don't know. Big Oil is one of the. I don't remember the story. I did ask that. How I don't remember the answer. Again, I talked to thousands of startups, and uh, it's hard to remember details of a conversation from 5 years ago. But um, they that is an obvious customer. But my point from it was that they didn't start with small, they didn't say, yeah, let me go find some small businesses that can test this on. They went straight to their ideal big customer and just went for it, which is ballsy, but it's, you know, it worked for them. I've seen that repeated over and over and over. I see a lot of startups that, and they're only targeting, like, say they're some kind of AI for accountants. That's a timely thing now, right? Everyone's trying to do AI process. Let's say, there's one guy that will be doing it, and they're like, yeah, well, we're starting with these small mom and pop accountants. It's like, okay, why? Oh, well, it's just easier. Um, I'm not ready for the big guys yet. And that's a mindset. They won't even try to call on the. And then there's someone else that's doing it that we actually invested in that went straight for the big guys. And they're going into corporate America, into CFO teams, and going to see, companies where the CFO has a team of like 30, 40 people, and showing them how they can save them like 10, 15 people within 30 days of implementing their process bots. And uh, that's a pretty cool. Actually, that's a startup called Capify. Um, well, they're doing pretty well, but um, they're going after. They from day one went for enterprise. They designed their product for enterprise. They never they never tried to make the product work for small businesses. They only went after enterprise. Um, and again, that's a mindset. And there's no right or wrong. It's just different. Every I can't fault the guy who thinks they want to test it first on small, and that's easier for them, and that's how they. And the guy who comes from a world. Now, in that case, this guy came from that world. He knows how to approach that world. So it's impressive, but not as impressive because he came out of that world. He came out of a big three accounting firm. He understands that world. He has friends in that world. He has the connections. So him going back to that world made sense. And he knows how to talk to. The other story was more impressive. Um, uh, so I don't. That probably answers that question. But
Hmm. Now, David, looking
so
back at your career, what would you say has been the most successful investment you've made, and why?
all successful investments I made were in the businesses that I started myself. Although I had to invest a lot of my own time in them as well. But yeah, nothing still beats the businesses that I built and exited myself as far as um, total return. As far as maybe IRR, there there were some angel investments that had some pretty good exits. I've had at least four now that were over a 50x exit. So where I got back more than 50 times net after dilution, after all fees and everything. I got back more than 50 times what I put in. I haven't had a 100x yet. I think the largest was a 72 approximately, 72, 73. So let's say it was a small angel check where I wrote a $10,000 check, back whenever. And then 5 years later, I got back basically almost $750,000 from a 10,000. So that covers a lot of sins. So luckily, from that early batch where I wrote a lot of small checks, and now I write fewer but bigger checks. But back then I wrote a lot of small checks as an early angel investor, just trying to learn everything and test it. I was learning by doing. So I was like, I'll write a lot of checks. I'll make some mistakes, but it's okay. Uh, Luckily, even though I made a lot of mistakes, a few turned out really, really well, and that kind of covers a lot of sins. One that gives you back 72x can cover 70 mistakes, and you can still be even. So uh, that's that's pretty good, and that's the power law at play. Any VC will tell you there's a power law at play. Out of every portfolio, you'll have you know half the portfolio will die, and out of the other half, uh, you know, only a small handful will do very well, and the rest of them will be mediocre. So most of your return comes from a really small percentage, and that you need diversification. You do need an absolute minimum of 20 investments in any pool, preferably 30 to 50 investments in a pool for the whole to guarantee a stable return by having a few really absolute winners that can pay back the whole fund.
Mhm. Could you talk about the story behind those like 50x or 70x exits, or what those startups were and why?
It's dumb luck. Like I said, I wrote a lot of small checks, and a lot of them did okay, and some failed, and a few. The ones that did spectacular were never the ones that I would have thought would. It's just like, oh wow, that one did really well. I had no idea, and it probably is a combination of them being people that moved really fast and got shit done and really did well. But I didn't know that until later, and they just did, and they were in the right industry, and there was no rhyme or reason. A lot of them also had exits at the right time. The whole market was doing very well, as you know, and so through 2021, it was a very frothy market. So, multiples were really high, and exit. You had enterprise SaaS companies selling for raising money at or exiting at 50 to 100 times ARR. So if you invested in the company, let's say at a 10 million valuation when they were really early on, they just had an MVP out, they had some early clients, and you wrote them a check at a 10 million valuation, and then they sell for even just, if they exit for $1 billion 5 years later, that's 100x. Of course, there's some dilution along the way, because they raised a few more rounds. So that 100x might become a 50x or a 40x, and that's really the story. You had a few that just had those exits, uh, one way or another, and usually just selling to Amazon, to Google, to Meta, to whatever, and for some nice chunk of money. And we came in early enough where we were at a much, much lower valuation. So it gives you that really large multiple. And there's quite a few other, 20x's, 30x's, and a lot of zero, not too many zeros. There's some shutdowns, but surprisingly, a lot of them you can kind of get your money back if they're structured right. If you're, um, a lot of them will try to have some kind of acquihire, some exit where they sell the assets of the company and have the employees sign on to a or another company and get enough money back to give something back to the investors, or sometimes even all your money back. So you get 50 cents to 100 cents on your dollar back quite often, actually, even from a company that fails. But getting your money back or getting half your money back is still a failure when you expected like at least you want a 10x return. You didn't put your money in and wait 5 years just to get your money back. But that's still better than zero. You get to live to play another day. So that happens actually quite a bit.
Hmm.
I've been fortunate that a lot of the shutdowns, I would say half the shutdowns, I got my money back.
Oh wow. What happens to the entrepreneur? Do they just get hired by the company that acquires
If
them,
they
and
have
then?
if they have that kind of exit, then yes, they often are agreeing to stay on with this other company, and they're probably getting some new equity in that new company. And there's so many ways these things get structured. Uh,
Mhm.
it, there's no one formula, but sometimes it's a true just merger of equals. Like we might have a startup that has great technology, but just wasn't as much on the traction and missed the boat on the fundraising. You might have a competitor that happened to do a great job on the fundraising, and they raised this big round, but they actually have crappy technology. So we have a better product. So you can have a merger of equals where they'll actually take the product from our startup and the money, but the other company has the funding, and they'll merge, and now you get shares in the merged company, and they all stay on. That's one scenario. That's kind of a good scenario sometimes. Um, there's a lot of scenarios.
Well, David, that's it for the questions I've got for you. Is there any other stories or lessons you'd like to talk about before we end it off?
Um, my favorite saying is ideas are cheap. It's all about execution. And I said that 12 years ago, and I continue to believe in that more than ever now.